Okay, Master Traders, we are on Module 6 of Moving Averages, so we are just about halfway into the seminar here. And as we go further, I'm going to start reinforcing more and more of different trade setup concepts, trend concepts, bar-by-bar analysis, continually reinforce the education. What is a setup? Why is it a setup? And in this case of moving averages, why are we using a subjective analysis tool? We are vehemently against subjective analysis as it relates to trend lines and Fibonacci lines and oscillators and so on. But as you'll see, this is an extremely valuable tool that we can use to speed up the analysis process. So let's continue. So they're very versatile, as I've said, and if you know how to use them, how to interpret them, realize they're not real support and resistance. Many will refer to them as such, as a 200-day especially being an area of support. It certainly does and can become a self-fulfilling prophecy since so many are looking at it, especially on an index like the S&P 500. 50 MAs, 200 MAs are widely used by institutions, mutual funds, and such, and even arbitrarily as being support and resistance where they'll actually buy at those reference points. Now, what we want from them is to eliminate the subjectivity and eliminate any indicators. We want to keep our charts free of indicators, but as you'll see, if you use these intelligently, they can speed up the analysis. And if you watch us in the green trading room or one of our webinars when we're scanning, you can see how quickly we go through it, because one of the ways that we use these moving averages is to see the alignment of them as they relate to price. So as your eye becomes trained to look at these pictures of where price is in relation to these moving averages and whether the moving averages are above or below each other or intertwined with each other, those pictures immediately project a message. And this is what we want, an objective way to speed up the analysis and recognize that picture. So we're going to use simple moving averages. Let's clear up any questions as to what we're using or why. If you like exponential, for example, if you were trading Forex, you might decide to use exponential because that's what other Forex traders are using. There's a tendency when there's more leverage involved to where traders will moving toward more esoteric type of analysis, looking for that holy grail. But in reality, simple moving averages work on anything. It's all about being consistent in what you're using and what you're looking at. So we want to watch the slope of a moving average as an indication of trend change, primarily the 20 and then the 50, since they're faster moving averages, obviously, than say a 200. The faster or the shorter the moving average is, the more closely it will track prices. Converging moving averages point to inflection points. Why? Well, because if the moving averages have come together, there has been a decrease in volatility from what it was prior, and the more recent price action is staying about in the same area. So a longer term moving average and an intermediate term moving average, or even a longer term moving average, they're going to begin to come together the longer the consolidation is. So simple moving averages, by definition, just simply drop off the period. For example, 20-period moving average 20 periods ago is dropped off. The new value was added in, and then that is added up, those 20 numbers, and then divided by 20, and there you go. You have a new plot for that moving average. So as time goes by, as you are averaging in the 50-period moving average or the 200-period moving average, the longer the base, the more those moving averages are going to come together if they were further apart. And then as prices begin to trend either up or down, and the new values that are increasing either up or down are averaged in, and the speed in which those numbers change, the moving averages will then spread apart. So when we view the distance between those moving averages and the distance between prices in the moving averages, we immediately are provided with a picture. And as I said, we're looking to just speed up the analysis. Obviously, we can see this just by looking at prices alone, but we are looking to speed things up. We're training our eyes to look at a certain picture, and when we recognize that, and we recognize what we perceive to be, from historical analysis, a picture of money, we stop and we look a little longer. We do some bar-by-bar analysis, and we then decide, is this an opportunity to place a trade? So the moving averages that we're going to use for swing trading, on the monthly MA, it's going to be a 10-period moving average. I'll explain why in a moment. On the weekly, we're going to use a 20-period moving average. And on the daily, we're going to use the 20, the 50, and the 200. So the master trader approach, looking at the daily time frame, is to be aware of what's happening in multiple time frames, the ones that we use, the weekly and the monthly. And we're going to be focused on what the trend is on those as we look at the daily time frame, and we'll then get insights as to what's happening on those other time frames. So let me show you how to calculate that and plot it on one chart. This, like pretty much everything that we do, revolves around simplicity. And things are simple once you know. It's an obvious statement, but it's true. Things that seem complex or confusing to you, once you understand it, all of a sudden it's simple. So how can we do this with moving averages? Well, what we want to see is the trend and location of one moving average from one time frame to another. So we have to do a small calculation of the number of bars in the lower time frame that make up a higher time frame. Then we simply multiply that number by the moving average in the higher time frame. That's your moving average in the lower time frame. And here you have examples. So a weekly 10-period moving average is the same as a daily 50-period moving average. You've got 5 daily bars equals 1 weekly bar. So we take 5 bars, multiply that by 10, and we have a 50-period moving average. Now, depending on the direction of that 50-period moving average on the daily time frame, we have a pretty good idea the direction of the weekly trend. So the weekly 20 MA is the same as a 100-period moving average on the daily. 5 bars times 20 equals a 100-period moving average. Now, you're probably already thinking, well, you didn't mention using a 100-period moving average on the daily time frame. Correct, because I know that the 20-period moving average is on the weekly, which I'm always going to be looking at, so I'm going to know where the 100-period moving average is on the daily time frame. On the monthly, we're going to use that 10 MA, same as the daily 200 MA. There's 20 trading bars on a monthly time frame. Multiply that by 10, and we have a 200-period moving average on the daily time frame. Here we have a daily time frame with the 20, the 50, and the 200. And I always keep my moving averages the same color on whatever the time frame it is. And so that 20 MA is blue, the 50 is green, and the 200 is red. And as I'm looking at this, I see that the 20 MA is above the 50 MA. Both moving averages are above the 200 MA. And the 20 and the 50 are trending higher. And I take notice of the distance between those moving averages. So, for example, let's look at a few spots on the chart here. Where prices move out of this consolidation, you notice the wide range bar. Notice the volume. Now, as I said, volume is a secondary piece of information, and our primary focus is volume spikes. So when I see a wide range bar coming out of a consolidation, and consolidations will bring the distance between the moving averages together, so I know that prices are not extended just by looking at this picture. Now, you can look at prices and see them going sideways and say, of course, they're not extended, but you'll see how this becomes important as time goes on to measure what's happening through the eyes of these moving averages. So we've got a wide range bar igniting out of a base on increasing volume. Terrific. Suggests that prices are going to go higher. Now, Wide range bars, as you already know, are momentum moves in a smaller time frame and create a void. So prices continue to move higher, and there's your void there. Now, prices are not that extended from the 20 MA. This is a visual representation. You can see here they weren't that extended, but the 20 and the 50, they were a little further apart. Still not a problem. Consolidation, and then the move higher, and now a bullish consolidation where prices catch up to the 20 MA. That in of itself is going to tell us pay attention. Now, of course, we're paying attention along the way, but our highest probability setups or situations are going to be when prices become relatively close to the 20 MA after a momentum move higher, and sometimes prices will retrace lower to the 20 MA, but when they go sideways, it's even more bullish because they didn't pull back, and this is the concept of creating support by going sideways after creating a void. Bullish price action. Now, I hope you're looking at this and taking notice of the fact that that bottoming tail bar broke below these lows and then traded back up again. That's what I call an event. Pay attention. That event means buy it above that bar's high, put a stop below the low, and then bar by bar analysis, see what's happening. Little bottoming tail bar, which was a tiny little red bar prior to becoming a bottoming tail bar. Buyer stepped up on the dip. Move higher, move higher, move higher, move higher. Higher, getting further from the 20 MA. Topping tail. Are we selling? No. Can you sell partial profits? You can decide to do that, but this move is getting started here. It should go higher. Other things that you're doing here is you're looking to the left. Is there a void that prices are moving into? We're looking at these moving averages and saying, hey, the weekly time frame is just getting started too. The 200 MA, which is the 10 MA on the monthly, prices just got above it. And the 200 MA is just starting to flip up here. So we can see through multiple time frames that this move is really just beginning, even though it's already moved from, say, at this point, $13, $14 up to $25. So we look at this objectively and say, well, prices moved up quite a bit here, but who's to say that they can't go up even more? And this is what keeps us in a great swing trading opportunity when we can look at it objectively and say, all right, it's short-term extended, but this is really getting started. Maybe it needs to consolidate a little bit, but you can see here it only consolidated a little bit and then continued to go higher. So bar by bar analysis, you recognize retracements. If it does retrace, if it goes sideways, bullish price action, everything that you're learning at this point is going to help you objectively look at what's happening. Lastly, odds are on the long side unless prices have moved up climactically. What is climactic? Far away from the 20. Moving averages are separating apart. And over time, as you look at charts, you'll see that some stocks move much further than others. So you can say, well, percentage-wise, is that a guide? It can be, but I've seen many stocks move much more percentage-wise than others. So you'll learn what's climactic, and just this picture right here is what I would call maybe pre-climactic. The more bars that you have going up in the same direction that are opening in the area of the prior bar's close or gapping and going higher, the more of them you have going up and more of where prices start to move vertically, the odds are increasing of a pullback or a consolidation. It doesn't mean that prices are going to collapse, crash, or some point where there's going to be some devastating type of loss against you. You can't think that way. It's just looking at it objectively and bar by bar, multiple time frames, and observe and see what happens next. Taking partial profits, nothing wrong with that. And then you're going to have to just sit through some correction if you believe that prices are going to be able to go higher. Now, this is how we would look at our daily, weekly, and monthly time frame. And you can't see the 200 here As it's a little further away, you can see where the 10 is here at about $60. And so you can't see where the 200 is, but we know it's down below here when we're looking at the monthly. We don't have a 100 MA, as I said, on the daily, but I look at my weekly and that 20 MA there, and I know that the 100 MA is going to be at around $64 or so. So I would know it's right around here where this consolidation is. And here we see that the 20 is above the 50. Over here, they were pinching or converging at that point. And then we had this bullish professional type of gap up where it came out of a consolidation. Notice the volume. So we have a volume spike on the gap and a bullish wide range bar. That suggests prices are going to go higher. If you apply some bar by bar analysis, think about what happened on the second bar after the wide range bar. Looks pretty bullish, doesn't it? So what we have there is a bar right here, which was a big red bar that retraced deeply into the wide range bar. And one of the concepts that I spoke about is that after a wide range bar, what we want to see is prices stay in the upper half or the upper third. And what we specifically want to see is the candle body staying up there. There are going to be times where you're going to see retracements into a wide range bar. But what we want to see is that buyers step up and we get a closing price up in the upper half and ideally the upper third of that wide range bar. Daily chart here, different picture, obviously. Now you can see the 200 is intersecting prices. You can see where the 10 MA is on the monthly time frame, and it's not going to be exactly the same price. So if you're looking on your platform and you're looking at the prices, you're going to see it's there, give or take a little bit. Meaning it could be pennies from a monthly to a daily. It could be a dime. And again, it depends on the price chart stock that you're looking at. But what you want to realize here is that the concept provides you as to what's happening in multiple time frames by looking at just your daily time frame. So here I know where that 10 MA is on the monthly, which tells me that things are going sideways there. This 200 MA isn't pointing up, it's flat. However, the price action here is such that it was bottoming. Notice the wide range bar coming out of the base, and notice the bullish consolidation right there at the top of the wide range bar. Notice the volume down here. That volume spike says, hey, pay attention. Now as prices come up into some area of congestion, we need to look to the left to see what's there. And looking at the monthly chart, looking at the weekly chart, we see that there really is a reference point of congestion there. And also this gap down here is certainly a concern. So what do? Well, if we're continuing to watch this particular stock, at this point I'm thinking to myself, well, this just got started out of this base here. The weekly came out of this support area down here and come up to resistance. Can this repair the damage? In other words, I need to see this now start going sideways and buyers start to come in. You know, the monthly did have a correction here. As I look at multiple time frames and I look at this particular example, it tells me set an alert, stand aside for now. Maybe this could develop after a while of some consolidation, some breakdown failures possibly. And then if it can recover from here, well, then the door opens to a larger move back up. We'll wait and see here, but what we want to take away from here is understanding, looking at our moving averages and the pictures that it's providing for us to understand what's happening, and again, to speed up the analysis process. All right, we're back to one time frame here, the daily time frame with our 20, our 50, and our 200. So let's take a look at what's happening. So on the left side of the chart, we have the moving averages aligned in a bearish alignment, meaning we've got the 20 under the 50 under the 200, the 20 and the 50 are declining, and as they are, a bottoming process begins. Well, before the process begins, there's that volume spike. Remember, when it comes to volume, our primary focus is spikes, which says pay attention. There was a big increase in activity. We don't know what it's going to do, so watch. What happens next? Apply bar by bar. A complete reversal of a red bar now being ignored that formed on huge volume. Does that mean we want to go long? Absolutely not. This needs to prove itself. We need more information. This trend is lower. Now, you'd be looking at what's to the left here. Why is this happening? Remember, we're always asking why. Why does prices turn at a certain location? And the vast majority of the time, it's going to be when you look to the left, there's support there, or in a higher time frame, it's at some reference point of support, or the trend might be up. So remember, you look to the left. Now, that move up was a power move higher. It moved up where it initially gapped up above the green bar, and then it did not fill the gap. It continued to move higher. There was a wide range bar moving up, and it just moves to the upside with no hesitation at this resistance. And then when it gets to the top part of the resistance, which is 100% retracement of the prior decline, which would be a bullish bar or bottoming tail in a higher time frame, what does it do from there? So we ask questions about patterns, meaning the current pattern, I see what it says and what it communicates to me. What occurs after that? Now, you're going to see what occurs after that, but by knowing historical patterns, we know what should happen, and we know what shouldn't happen. So think about what shouldn't happen. It shouldn't go all the way back down to the low. What should happen is a very minor retracement to an area of minor support, or more bullishly, it should go sideways and create support. And that's exactly what this did here. It went sideways. So when it hit the 200, a subjective reference point, but that is in alignment with this resistance area here, it attempted to go down and it stopped. And then when it came down to that area again, it formed a bottoming tail bar. And then it moved up strongly. Little volume spikes. Pay attention. Bottoming tail bar when it tried to dip down. So the message here is that every time it tries to go down, buyers are stepping up again. Now, notice the 20 MA. It's starting to rise. And it's rising. And the 50 MA is no longer declining. It's flattened out, and it's beginning to rise. Now, as it moves up here, and we've got the beginning of this move, question mark, wide range bar, volume on the wide range bar, igniting a move out of the base. So why did it pull back like this? Well, when we look at patterns, there are going to be points in time, for whatever reason. It could be market related. Some news item came out that affected the broader markets, or possibly the stock that we're looking at, but prices broke out, and then they traded under the low of the breakout bar. So there you have a breakout failure. That creates a lot of uncertainty, and those that are longer saying, I better get out of this thing. Right? Well, maybe you should under a situation like that, or at least take partial profits. It's certainly a bearish event that occurred, and we don't know what's going to happen next. It could have reversed right back up again, but in this case it didn't. So there's damage done here. This is a lot of uncertainty, because what was happening here was extremely bullish. This was all bullish. This was bullish. So now we have this event that has now created all of this uncertainty. Well, as it moved down into support, we need to now watch what's happening at our reference points. That 200 is going to be a reference point. And when I see any moving average and I'm thinking, hey, this is a point in time where buyers might step up because of that moving average, I'm looking for confirmation by looking to the left. Is it in an area of support? this was bar by bar analysis. Green bar moves up, gap down, closing at the high. This is repairing the damage. And we could see this was a bottoming process. And while this is not what I would call a no-brainer long type of setup here because of the depth of retracement, it is one in which tells me that buyers are stepping up again, that damage is being repaired, and it's happening at the right location. Now we get another 100% retracement and a greater than 100% retracement, and then a gap up and another reversal that takes out the low of the breakout bar. This stock is a little bit wild or there's some uncertainty here, but it is making some big moves. And what begins to happen here, you can see this bullish price action that's occurring where it is now beginning to go sideways. You got a bottoming tail bar and it's moving up. Now, look at the moving averages here as they're out there starting to pull apart from each other, and these are, nicely above the 200. Look at the arrangement of the price bars now. Look at how they stay relatively equal in range and close together. And this becomes more of a picture of certainty after this bullish price action here. So while this was bullish and the move was just getting started and there was some erratic price action, now we see certainty that's occurring within this. And ideally this would then go sideways. Of course, you're looking to the left to see, is there a void over there? Everything has to start coming together where you're continuously doing this analysis and objectively looking at what's occurring in the stock you're looking at. And of course, you're going to be doing this as it relates to the broader markets as well. Bottoming patterns, they can display a change, and they do display a change from certainty. So in a downtrend, there's certainty about it going down. And as prices begin to bottom, there's uncertainty. There's uncertainty as to whether that downtrend is going to continue. So during this process over here, as prices began to bottom out, and you notice the retest of this area here that buyers stepped up again, and this was a relatively powerful move up here. Look at the way the bars go up. One bar closing where the opening where the other bar closed, or gapping up and it goes higher. And we see the red bar being ignored, a wide range bar without any follow through to it. So we've got this bottoming process going on here, pullback. Notice the bottoming tail bar and this red bar ignored, and then this breakout. They can provide us swing trading opportunities, but they do tend to be whippy. And we want to see that power move. We want to see it happen on big volume for that type of confirmation. That bottoming patterns do have a tendency to disappoint. They're not in clearly defined uptrends or clearly defined downtrends. So when you trade them, trade them a bit tighter, be very respectful of an event like this, to step aside. And just historically, bottoming patterns do just that. They bottom, they have false starts, they have deep retracements, they begin to rebuild again. Some stocks can take months, some could take years after a big correction. Stocks that are in uptrends in higher time frames can have a correction on a daily and begin to repair the damage in several weeks. So we put those corrections in the context of what's happening in multiple time frames as well. That gives us insights as to the probability of a bottoming pattern actually turning back into an uptrend or not. And that all being said, market environments can foil the best looking type of bottoms just because of corrections where traders just step aside during a market correction and just wait and see if buyers are going to step up again. And you might think that institutional investors maybe would stand their ground, so to speak, and hold on. Well, they will longer than a very short-term trader, of course, but they will raise cash during a period of uncertainty. They may not exit a whole position, but they are going to unload some shares if they perceive to be that there's a lot of risk involved. Common sense. So here look at this move up. This price arrangement here between these candles is pretty whippy. Prices were above the moving averages. They were above the moving averages over here. It was a powerful move up, and we get pullback, and you see that you've got a lot of overlapping bars and tails. So there's still a lot of uncertainty going on here. And as the moving averages are starting to rise, you'll notice that they're not as smooth as some of the other examples. And if you're not sure what I'm talking about, go back and look. And you can see how this has kind of a dip and goes up and some wiggles in there. In any event, you can see the price action is still erratic, where you get big move down and it comes right back up again. So we've got this downside type of shakeout where prices come up into resistance, and they actually act quite well here, where they go sideways and this topping tail doesn't follow through, and then prices break out. Well, we can see that there's something that went on over there to the left that was a pretty bearish event, that big negative down bar. It doesn't mean that this is going to happen, but if you bought that breakout and prices retraced all the way back down again, you have to say, you know what, this could be a problem. Right? This is erratic price action is still continuing. Maybe I should just step aside, reevaluate. I can always get back in again for a small commission and see what might occur. And so if you're uncertain, there's nothing wrong with scaling back to reduce risk. Now, prices eventually, they broke to the downside, as you can see. They stalled at this support area, but they just couldn't get going again. And the 20 moves under the 50. They're both starting to decline. Look at how smooth. Let's clear this up here. And let's look at this concept of how smooth that 20 is moving versus, this kind of wiggles that's going on there. It's a slight nuance, but something to take note of. So prices are moving rapidly here. When they hit support, they cannot move up very much. They drop, eventually break below the 200 MA, which is the 10 MA on the monthly. And so this monthly chart, we know, was rising over a longer period of time, because look at the 20, that 200 MA. It is rising. It was still rising, but this sharp move down broke through that 10 MA on the monthly, and on the daily I can see that it's violated multiple areas of support. It's now under the 200, short-term bearish, and you've got this retest here, and notice this 180 reversal that occurred. Bearish event. We could short that. Now it gapped down. We're still looking for lower prices. Could this pivot low hold? Maybe. Look to the left. Why did it occur? Maybe just short-term overdone to the downside. Maybe the market bottomed. In any event, this arrangement of moving averages and trend is a bearish one, where we're looking for lower prices. Okay, so different example here. These moving averages should be jumping out at you as saying, look at the distance between the 20 and the 50 to the 200. Over here, notice the volume, a pro gap up. It gapped above the high of a red bar on big volume, and then it began a consolidation, did move down into the unfilled gap, and then we see these RBIs, red bars, being ignored. And as prices are beginning to tighten up, another pullback. So a consolidation, overlapping bars there, not something we're really interested in, other than to say, hey, this is something we should pay attention to. Let's set an alert. Let's let the software monitor this and see what happens. And just, again, take note of the arrangement of all these candles here and how the arrangement changes here. How the bars stay relatively close in size. There isn't a lot, there's hardly any red bars here. We've got one little red bar here. Most of the closes are above the opening price and they move up. And then after it gets a bit extended from the 20 MA, and the 20 gets a bit extended from the 50 MA, and they are getting extended from the 200 MA, and we see the 200 is rising here, but prices go sideways. And once this pivots and retests, red bar being ignored, this is bullish price action. This stock is going to go higher. Look at this pullback and retracement into the rising 20 MA, and now look at how this corrective action brings the moving averages together. So again, a visual aid that helps speed up the analysis process. I hope you're starting to see all of this, how powerful it is and how it can come together when you combine it with bar by bar analysis and trend analysis and looking at the volume. Notice the volume spike that occurred right there on the move up. So all of this puts the odds in our favor as we put all the pieces of this puzzle called technical analysis together in a master trader way. I think you can see how powerful and what an excellent tool these moving averages are as a visual aid. They're not real support and resistance, only price is, but they can become a self-fulfilling prophecy, especially the ones that we use on the daily time frame, because institutions use them. They're focused on as buy areas, the 50 MA, the 200 MA. So that's why we use them, and we use them in a simple way. Simple moving averages, not exponential, not weighted, not triangular, not optimized. Right? We keep things simple. That truly is the key to success, is simplicity in what you're looking at and the combination of the concepts we're talking about. We don't trade a moving average per se, but they're an excellent tool. And if you use them the way I've explained, you're becoming a master trader and the dollars will follow. Let's move on to the next section. All right, swing traders, let's talk about multiple time frames. We've been doing that already to some extent, but we're going to get a little more detailed about that here. So let's get going. All right, multiple time frames. What are we doing with them? We're expanding data, we're compressing data. So as we look at higher time frames, we're taking data from a lower time frame and we're compressing it. When we take higher time frames and we expand the data, we're going to longer time frames. So when we do that, we see a different arrangement of candlestick patterns or pictures. So when we compress information, we may not actually see momentum slowing down or an actual turn in that lower time frame, which is normal. Understanding this, we don't want to look at too many time frames. That leads to confusion. We want to stick with our macro time frame, our micro time frame, understand what's happening there, and not be looking at so many time frames that now we're getting into analysis paralysis. The tools that we have will guide us. Now, at times, we're going to be entering after a large bar or a bar opposite the direction of a move, but we're going to be trading in the direction of the trend in alignment with support and resistance and the other concepts that we've spoken about. So the odds are in our favor, and here our objective is to understand what's happening in multiple time frames and not be confused by it. Primary time frame, if it's whippy or confusing, you move to a higher time frame. So if we have erratic price action that is confusing, which is telling us stand aside and that there's uncertainty, but for whatever reason we're interested in this particular market or a stock, compress the data. Move to a higher time frame and see if it brings clarity. If it doesn't, stay away. If clarity is there, it'll reinforce a bias, and then you wait for your lower time frame to come into alignment where it tightens up, where the picture of certainties begins to be displayed. And the other alternative is to be, if you're entering from the higher time frame, you're going to be having a larger stop, smaller share size, and so you're in the position and waiting for that certainty to display itself, but with a stop far enough away that you're not going to get stopped out by a wiggle. In other words, you're trading from the higher time frame rather than the smaller, in this case being the daily. Now, if prices are climactic, you're not going to be doing that because of the fact they are climactic. They've gotten extended. So you stand aside, you reevaluate, and you wait for information that supports your bias. So what's our goal here? is the alignment of pictures in multiple time frames that we're using, which means trend or counter trend, those trades are aligned in multiple time frames. And it's alignment about your investing and trading goals. So we're talking about swing trading here, not day trading. It's a completely different focus. The foundational concepts, while the same, we're using different time frames to do that, lower intraday time frames. There's no reason for me to look at a 5-minute chart if I'm swing trading. You've probably done that. I've done it in the past. I've given up good positions because of a trend break on a 5-minute chart or a wide range bar on a 5-minute chart. In other words, getting scared out of a position that there's nothing wrong with it on the daily time frame. So keep it in perspective. There's going to be times where, a position doesn't work out. The start of a breakdown of a position obviously starts in lower time frames, but you can't be focused on 5-minute charts if you're going to be a swing trader because there's just too much noise there. So we don't. The focus on day trading is looking at what's happening from your higher time frames. Now, the monthly time frame is a long time frame that we can utilize, but until that bar is actually completed, it really doesn't make sense to be looking at it the first week of the month and you've got 3 weeks to go, and any bar that's there can be completely different by the end of the month. Let's understand transitions. So there are transitions in a higher time frame that are seen in a smaller time frame. And in the upper left there, we're looking at what would be the higher time frame. And in the smaller examples, we're looking at what would be the transitions from that green bar into the red bar. And that can happen in many different ways. And when we talked about candlesticks, we talked about the fact that these price patterns can happen in so many different ways that we can't say that, hey, it has to happen like this, which is a great pattern. Because there was a breakout failure there. It was a big green bar that turned into a topping tail bar. However, we know that this pattern is similar, and because the higher time frame has already given us our bias, that this picture can be used the same as this picture. Sure, this one is a better one, but this one will work out as well as this one will. Just that this one has more of a shock element to it. This one is another variation where there's been a little breakout failure there, a little bit more pronounced just because it was a closing at its high and then a gap down and it broke below the low, whereas this one didn't break below the low yet. So a bit more bearish there, and this one we'd say was the least bearish or benign as far as the turning point happening on that last one. So it can happen different ways. The higher time frame, we've got a bias where the turn should happen, and we're able to observe the actual turn from green to red in a smaller time frame. On this slide, we're taking a bit more detail, going a little further in, and as mentioned at the beginning of the course, these individual modules and concepts are about understanding that particular concept thoroughly. So as we're looking at this, it's for you to understand this transition and looking at things a bit deeper in multiple time frames. That's our focus here. So we've got this big red candle on the left right here. And what we're looking at here is saying, okay, there was this transition to that big green candle. Well, depending on the time frame that you're looking at, it's going to be dependent on how many bars you see. How far down are you going into smaller time frames where this one bar could be where it's just several bars and then the turn occurs, where if we go down to even a smaller time frame, we see that there's this slowing in momentum in the transition from this red bar into this green bar. And if we went down into a smaller time frame, we might see these bottoming tail bars and a retest and a more detailed pattern. Does it mean that we have to go down here? No, because our method requires that prices trade above a prior bar's high for entry. So what's happening between these bars, even if we don't see it, we don't need to, right? Because this is what's going to give us our entry point. Now, ideally, when we look at these individual bars, let's remember bar by bar analysis, whereas if this bar was a bottoming tail bar, I would find that even more attractive because I know that in a smaller time frame, there's been some kind of dip that's broken some support and then prices have turned back up again. Let's continue to talk about these wide range bars and multiple time frames and looking inside where we're taking this X-ray here. So what we're looking at here on this slide, obviously, is we've got this wide range bar here. That's obviously one bar. We've compressed what's happened in the smaller time frames into an individual bar. If we break that down, what we could see, and let's just assume that this is whatever, the monthly bar. And here we're looking at a weekly bar, or this could be a weekly and a daily, and this could be a 60-minute chart. So sometimes, even as swing traders, we may decide to look at a 60-minute chart. That isn't the focus of this class to do that, but you do understand the concept here from what I'm explaining. And the concept here is that in the time frame that we can see where the bars are coming down in a fluid way, and you can see here lower highs, lower lows as it's pushing down. So as I said, we want to assume we have an uptrend in a higher time frame here. And in other words, this, and let's just say, hey, our 20, it's coming down to our 20, and it's above our 50, and they're rising, and we're looking for a turn here. Okay, fine. This came down in a fluid way, which is not as bullish as prices that may have retraced, let's just say in a more bullish angle of retracement, something like that. So we've got a steeper angle of retracement. And if we look inside these bars here, it may actually look like a trending move to the downside here in this time frame. So what do we want to see here? Well, with an angle of retracement like this, clearly there has to be a turning point. If it happens in, say, let's just eliminate this. If it was to happen in 2 bars on that time frame, well, this probably starts going sideways like that, but it may not have violated the trend. If we were to get a 3rd bar on this time frame, and what I'm getting at here is trying to find the ideal type of setups where there's been stabilization after a sharper angle of retracement that has been fluid as explained. So if this goes sideways for multiple days, let's just say this is the daily and this is the hourly, pick the time frames, the focus here is the concept, and that on the smaller time frame you're getting retests, and where we're getting this basing type of pattern where you're moving away over time from the bearish retracement. Whereas if we were to get that type of bullish angle of retracement above the 20 MA, it's already, that angle of retracement is several bars as well, and it's forming some support. But this one being more bearish, ideally it's going to take a little bit of time to rebuild or repair the damage. Now, remember individual candles that form, and let's say for the moment the candle that formed here on this pattern was a wide range bar, and in addition to that it was a wide range bottoming tail bar. That scenario would be okay, right? Whereas maybe this has not based out too much. I'm sure it would, but what you would have in a scenario like that would be a downside shakeout pattern, which would build up some support, and it would be a pattern in which there's that shock, where there'd probably be like a climactic type of a move, which those that were possibly long, that were holding through this, they gave up their shares. So a wider range bottoming tail bar where that would display a climactic emotional type of a move would be one in which we'd find that attractive as well, to get long above that bar. And so when we see these kind of downward moves like this, again, we're assuming uptrend, sure, there'll be stopping points possibly above this, but the bigger picture, right? The big picture, the uptrend, multiple time frames, all of that suggests the ability to get above resistance areas. So that is the same idea behind buying a pullback in price within an uptrend to minor support in a rising 20 MA. That prior high is going to be resistance, but the big picture guides us to the probability that prices are going to overcome that prior high. And here we're taking that same idea or bias and drilling it down into smaller time frames and understanding what's happening there. So here, let's assume that prices are in a downtrend on our macro and our primary time frame, or it's a wide range bar igniting a move down out of a base, and we have the same scenario of a wide range bar, multiple bars, momentum move inside of that bar, and then even a smaller time frame, we've got a trending type of a move. So I've drawn this one here where you've got the end here accelerating, or you've got a wide range bar ending here where we can see the complete candle. And what we want to see in the bearish scenario is that prices are going to stay in the lower half, and ideally the lower third or so of this wide range bar. While we're looking at one individual bar, and we might be doing that as a swing trader, looking at our daily bar like this, and this could be what happened intraday, this is giving us an objective reference point to say whatever happened here, however that actually formed, as long as it stays in that lower half and closes below that, the assumption is that what's happening in the smaller time frames will be okay. Ideally, it's going to stay in that lower third or lower quarter. Now, as prices do whatever they're going to do in the smaller time frame, we then mark off our major support point, and what we want to see happen is it stay below that ideally, but it could change the trend on that smaller time frame. And I'm repeating, this is about understanding what happens in multiple time frames. Our focus here as swing traders is going to be our daily, our weekly, and to some extent the monthly. So when this retraces here, it could overtake this area, this swing high. But what we're looking for, the ideal scenario would be for it to stay below. And because this is a void here, what we're looking for is a retest pattern or an M-top to sell short. That type of situation, looking for prices to continue to go lower because of our higher time frame bias. Short review, multiple time frames, they guide us to the alignment of trends and inflection points. Now, it can be rare to have all time frames in alignment. The more time frames you look at, the greater the probability that they're not all going to be in alignment. They don't always have to be. Expecting them all to be can lead to indecision. This is the mindset of perfection, the holy grail, a fear of losing any money, looking for that perfection. We don't need it. Our focus as swing traders is to look for our macro and our micro time frame to be in alignment with trends, support, resistance, and the price patterns that say that prices are ready to move in the direction of the prevailing trends. So our job is to pick our time frames based on our bias. Right? We are looking for that primary time frame to be in alignment. The time frame below your primary can be used to refine. And so this leads back to my comment that if we were going to use an hourly time frame to refine an entry point where our weekly and daily time frames were in alignment. If you want it, you could certainly do that if you're in front of your screen, but realize that your higher weekly and daily time frames being in alignment and getting your reversal in your daily time frame where your stop is going to be placed based on that higher time frame. The idea or theory behind that is that it's going to be far enough away to sidestep any wiggles that are going to be happening in the lower time frame, and which reinforces what I said earlier too about there's no point in looking at 5-minute time frames if you're a swing trader. Right? The idea behind swing trading is to find our trades based on our time frames and plan, and even being able to place an order at market open or prior to market open and saying, if prices trade above this level, buy. And if that happens, put a stop below this level. They can automate that, or you can, do that manually, of course. But the idea here is to be freed from the intraday time frame and sitting in front of a screen for endless hours. Let's continue looking at multiple time frames. And the example on the left is the weekly time frame, and we see this huge wide range bearish bar. You see the star above it. It's a powerful bar. It engulfed multiple weeks. And so that type of bearish bar strongly suggested that prices were going to go lower. And that was followed by an inside bar, or what we call a 1, 2, 3 type of continuation pattern. So this was hanging on a little shelf of support there, but that bearish bar being at support should still follow through to the downside because of the potency and power of that huge bar. Now, as it says, while it's powerful, it's the weakest link, because you understand the concept that a wide range bar is a momentum move in a smaller time frame. So if it doesn't follow through, it's a shock, and now there's nothing to stop it from going higher. So looking at the daily time frame, you can see the momentum move here, and then this stabilization down in this area. So the expectation is not for it to go back up again. The point of this slide here is to understand that it is the weakest link, and that this is a possibility that it could retrace. And the fact that it did really is a shock in a sense. We would not have been caught in that, because we would require this to trade below this low to trigger it as a short sale, which would mean that it went sideways here for a period of time, and then it broke lower. So we would not have been caught in this, but we want to recognize the possibility that this could happen because of the fact that this is a momentum move. Now, one of the concepts, I'll just touch on this shortly here, just so you understand it, because it's probably raising the question for you as to, well, what about all of this? Well, one of the concepts from Master Trader Technical Strategies is that if prices trade above an area and below it, it neutralizes it. In other words, it's kind of used it up as reference points of support and or resistance. And in reality, the only thing that really matters is this part right here. And this price action actually proves it. I mean, over the years of watching price action and questioning why certain events happen, when it appears that, you've got all of this resistance to the left there, because it's beyond what's directly to the left, meaning this move down, the reality is it's meaningless after prices have traded above it and sliced back through it like that. It's as if it doesn't exist anymore. Yes, you can see it, but you have to recognize what's happened here, and that is the weakest link. And if this doesn't follow through to the downside, those that are shorting, let's just back up here, those that would probably be shorting here are going to be getting caught on the wrong side, and that could create a lot of demand to push prices higher. So this isn't our expectation for prices to retrace back up. It's to recognize that it really is the weakest link, and it's supposed to follow through, but if it doesn't, it could have a reaction back in the other direction. So we covered this, just reviewing at this point our weekly time frame and our daily time frame, and how we have a macro view and a micro view, and we're looking for those two views to come together, whether that's pullbacks or it could be a consolidation that creates support. We're looking for alignment of our time frames with an event, bottoming tail bar, one bullish 180 type reversal, bullish wide range bar, 1, 2, 3 type of pattern. Many different ways it could happen. We're looking for patterns to occur that tell us to take a position when we have multiple time frame alignment. Now, counter trend setups. Well, at some point, prices will accelerate to the upside or the downside. And how do we handle that? Well, back to trend analysis and turning points and support and resistance. So in this example, what we're looking at is that prices begin to accelerate, and you can see here how these moves up and down are about the same, and then they expand, creating these voids below, and expand, and as they push up into this area of resistance or supply, the probability of that trend ending increases dramatically. Why do prices accelerate? More buyers and more buyers, fewer shares for sale, or demand is overwhelming whatever supply there is. Why does it happen up in an area of supply? Because the majority either aren't aware of it, they don't care, it doesn't matter to them that prices have been trending higher for an extended period of time and possibly going vertical. That is all about a reflection of greed when prices are going up and fear when prices are going down, where, rational thinking is no longer part of the analysis, or maybe it never was for some. But as it comes into that supply area, as master traders thinking objectively and intelligently, we're not going to get in front of that. But what we can do is look inside of what's happening here and looking in our micro time frame and looking for that sideways price action. We would combine that with bar by bar analysis, eventually the break of a major support area and a retracement or consolidation with the appropriate candle pattern. That would tell us that we can go short and trade against what's happening in that higher time frame. Right? So you flip over this concept, right, for longs where it's going down, and we looked at that in one of the wide range bar slides where I explained to you as it went down, or maybe how it came down to multiple bars, and what we're eventually looking for, some bottoming process where things turn back up again. A little more review of our multiple time frames and looking at the daily time frame. Monthly 10 MA, same as the 200. Weekly 20 MA would be the same as a 100. We don't have that on the chart, but we know where the location of that 100 would be by looking at the weekly time frame. And on our daily, we've got a 20, a 50, and a 200. And as we look at these, we say the 20 does not have to be rising for us to take long setups. Because in this picture that we have here, we know that a correction was ongoing because the 200 is declining, but prices started trending up, and eventually we had a power move up and then a pullback, which turned out to be a downside shakeout and a consolidation. So we look at this objectively, intelligently, losing multiple time frames, and of course, look to the left. Is there a void here? And if there is, the start of this move, right? It's the start of a move. Look at the 200. Look at the distance between the moving averages. This should go significantly higher. Daily, weekly, monthly. So we're looking inside of the bars here, and as we look inside of those bars, here we've got this 180 reversal right there. Sloppy bottoming type of price action. As already mentioned, sloppy price action in a lower time frame, if we compress it, we should see things quite a bit clearer. So that green arrow is pointing toward the exact spots. And here we do see tails on the top and we see some tails on the bottom, but we recognize this as a consolidation up at the top of the range. And notice the size of the bars here, here, and how they tightening up here. So certainty is coming into this stock as the ranges and candle bodies begin to tighten, and that bottoming tail bar that formed right there was a bearish wide range bar that went to the bottom of the range, but the body closed in the top of that wide range bullish bar, and that is a great pattern to suggest that prices are going to go higher. The monthly time frame is in an uptrend. Yes, there's a big bearish bar there, but bearish bars are supposed to be ignored in a bullish trend. You remember that from a prior section. Of the low of the wide range bar, there was a transition into this bar here. I want to say, for a moment here as we're going through these examples, that I'm giving you a lot of information at this point. Some of you might feel a little overwhelmed with digesting this. It's understandable. I've been doing this a long time and teaching these concepts, so I understand what students go through to absorb this information. The point here is you want to focus on these concepts, meaning here multiple time frames and compressing data and recognizing the foundational information as to what is a picture of certainty, uncertainty, what is the arrangement of those candles, what do they look like, the fact that you can compress data when things look uncertain, as they do here in this example of this daily time frame that's in a downtrend here. We've got, you see the 20, how it's got these bumps, as I referred to them, rather than a nice fluid kind of straight movement down. So the bottoming process that's beginning here leads you to questioning why. Not that you have to do anything at this point, but as you go through this information and listen to it multiple times, you'll see that it's really a lot of common sense thinking. When you boil it down to that and understand it, and then looking at that and then picking your points when you have the alignment of a picture of certainty with multiple time frame alignment. So as we look at the weekly, and I look as I compress this, don't you see how it brings clarity as to what's happening here, that this bottoming process is happening after this trending down, and there was this shakeout, right? The bottoming tail shakeout. Notice the volume that occurs at this point. Do we want to do anything? No, not yet. We're just recognizing what's happening here. So as prices are coming down, what I explained to you on the slides with the wide range bar and multiple time frames is what's happening right here. We see that prices have moved down. They're in a downtrend. And now we recognize that it's in an area here of support where it should turn, and it's become climactic, and we've got this big green bar. Well, as I drill down to this time frame, what I want to see is that sideways movement that's going to take a few weeks and maybe another month, where it goes sideways here and builds this support, and to where this whippy type of price action begins to tighten up. And now it's developed to where prices could move up into what should be a void, which was created over time, and these moving averages are going to start flattening out to where the 20 starts to inch up over the 50. So as this picture evolves and we see what's happening on the higher time frames, it points to us as to why it's happening and provides us with an opportunity to trade long. And so it's not in an uptrend yet. I mentioned bottoming patterns have a tendency to fail or be whippy until they eventually get into that uptrend. And we know the picture of that. What it looks like is when that 20 is rising above the 50 and the 50 is rising. And eventually, well, this one could take a while before the 200 is eventually under here. But that's another excellent point to recognize that we can be going long a scenario like this where the 200 is up here, and we recognize that and say, well, when it gets up there, odds are there's going to be sellers up there. So our plan then becomes that because of the price action, as explained, it's not here yet, we can trade a long setup with a target area and recognizing that the 200 is up there above waiting. Another example, daily, trending up, right? Moving averages are trending up. Recent bullish price action of going sideways. Red bars ignored. What should you do here? Well, look to the left. And sometimes when we compress data, right, that's one of the reasons we compress data. I can scroll back on the daily, but if I compress it, I see more information, and I see the weekly is into an area of resistance, and that there's a wide range bar after prices were trending up for a while, rather than an igniting wide range bar like we have down here on nice volume and a red bar ignored. We've got a wide range bar into an area of resistance. Now, I like this daily chart, so what should I do? Well, I would say let's wait for that to consolidate a while and see if this data or this demand could absorb the supply that's over here, and maybe the 20 MA would eventually catch up, and we bar by bar analysis would give us more red bars ignored or bottoming tail bars to where this could be ready to make new all-time highs. You can see the monthly is a whippy consolidation up at this resistance area here. So the message here is to stand aside. We have a neutral to bullish bias, and we're going to wait to see. But the takeaway here is that this bullish daily time frame is not one in which we should be looking to buy above these highs at this point in time. It's not that far from the 20, but the fact of what it did on the weekly and up at resistance tells us that this isn't a high probability setup to be buying any kind of a breakout, especially one that isn't as developed as we would want to see in this situation like that. Bearish upside shakeout. Well, bottoming action here. Not totally unusual for such a thing to happen. Have an upside move that winds up failing and coming back in again, and then buyers stepped up again, and this sideways price action that is occurring over here, it's still pretty erratic, but we're getting these red bars ignored at these start areas. And then inside the green box, we see this bullish price action that begins to occur. And then the wide range bar up, you'll of course take notice of volume spikes that are occurring. That's a little baby spike, but notice it happened on a red bar that didn't follow through. And then we start seeing creating support, sideways consolidations. Notice the big bottoming tail bar right there. That was a big red bar that turns into a bottoming tail bar, and the red bar ignored. So bar by bar analysis here. We have our 20 rising. It's no longer whipping back and forth through the middle of prices, which is a picture of uncertainty. The 50 is rising. The moving averages are now getting above the 200, and prices are now trending up. Bottoming tail bars, red bars ignored. Again, you're looking to the left. We're here looking for pictures that communicate a continuation of this bullish price action. I've already spoken about volume, and these are your foundational volume guidelines. My primary focus is spikes. This is the ideal where volume increases in the direction of the prevailing trend, and ideally it's a volume spike as prices break out on a wide range bar, and as prices pull back, it happens on lower volume, and then volume picks up again if prices pull up into an area of support in an uptrend, or in a downtrend come up to resistance. We want to see that activity pick up, but it's not an absolute necessity for that to happen. Prices can continue and buyers will step up without volume increases, but the ideal is when a move starts, a power type of move, a wide range bar or multiple bars moving up out of a consolidation, that you see this volume spike. That's your confirmation, and that's the most powerful thing that you can take away from volume, is to recognize volume spikes where they're igniting moves, potentially ending moves where they become climactic, and then you get a volume spike. But the pullbacks on lower volume, it may or may not happen. I mean, we heard for years and years that the market could not continue to move higher because of the fact that it was moving up on lower volume. Lo and behold, it's been going up for a number of years on lower volume. So that theoretical of that prices cannot go up on low volume is false. The same way of trend lines being an indication of a trend break is false. And about Fibonacci retracements being real support or resistance, it's false. So there are many concepts related to technical analysis that are accepted as fact that are absolutely are not. And looking at it objectively, it frees us from that misinformation. So volume, pay attention to the spikes. That's the takeaway there. And here's examples of that. So when we see these big spikes that are occurring on these examples here, right? Gap down, big volume spike. Pay attention, huge wide range bar. Prices coming down to an area of support, volume spike. Pay attention. Coming down hard, wide range bar, volume spike in an area of support. Here we're seeing this bottoming type of price action that's occurring. Why? Look to the left. Look at your higher time frame. Look at the weekly here that's occurring here in the area of this prior bottoming tail bar, red bar being ignored. Are you absorbing the power of this information here and how putting it all together puts the odds in your favor? Now, as we drill down inside of here, this wide range bar, huge volume spike, buyers are stepping up here through this whole area and accumulating, and we see that on the weekly time frame. And now as it begins to improve, here's the pullback at the big green star. So while there's still that level of uncertainty during this bottoming process, after prices move up, as they did here, and take out this resistance area, that bottoming tail bar is a little continuation, which is happening right here. You're seeing that in multiple time frames, and this whole bottoming process here that took a few months resulted in this moving up, and then you see how the ranges begin to contract, and what we've covered already. Another example, weekly uptrend with rounding bottom and bottoming tail bars, which we have right there. And you can see it here. Now this is pretty whippy type of price action, and you can see how the 20 MA is intersecting through the middle of prices. And at that point in time, we really don't want any part of this. However, as time goes by, things begin to change. They evolve. And we see prices clearing this area. That red bar that turned into another red bar as it broke down on volume. Prices started going sideways again. Bottoming tail bar. Notice there wasn't a big increase in volume on that one, right? So sometimes it happens, sometimes it doesn't. And then we get a nice consolidation here. But that's the money bar. right there. So there's the breakout. And then this was a big red bar engulfing all of this area, and it turns into a bottoming tail bar, wide range bottoming tail bar, range expansion bar. You've got climactic kind of move if we were to look at this in a smaller time frame. It's emotional, and then the bottoming tail bar shows commitment, and then there's this move up here. And looking at this on the weekly time frame, you see that rounding bottom that occurred there, and boom, and it was trending up here. Right? All right, let's look at another example. This is a long section, folks. I know it is, but it's so important, and I felt it necessary to give you a lot of examples and a lot of explanation to understand what's happening in these multiple time frames. So you do know you can pause it at any time, take a little break, and come back to it. That's the beauty of having these courses recorded like that. But let's continue as I explain here what's happening on our weekly. So on our weekly time frame, we've compressed the data. That's the definition of going to higher time frames. And what you see is just a fluid movement of bars going up. Well, that's great, and it tells us that that's bullish and it's going higher, but the weekly time frame doesn't give us any pattern of entry, and it doesn't have to. Our primary focus is the fact that it's going up. We've looked to the left, we've done our multiple time frame analysis, we have our bias, and now as we move down to the daily time frame with that bias, we look at what's happening. Wide range bar moving up. That bottoming price action and that retracement is bullish. This bottoming tail bar that was a downside spike resulted in the bottoming tail bar. Bullish price action at the area of that topping tail bar and that consolidation. It's bullish. The moving average is pointing to the upside here. Prices are going to go higher. Pull back into support. Red bar being ignored. And so on. We just continue the process over and over again. On this side, we're taking a look at the volume spikes. We can see that those volume spikes are occurring on big red bars, but they're being ignored. And we've got rising 20 and rising 50 with the 20 above the 50. So prices are trending higher. And I'll say that, this pattern that we have, it's not all that attractive, quite honestly, because it's all whippy. But we're recognizing these spikes, and it's still trending up. And this is what I refer to this as a self-correcting uptrend, and they're really difficult, if not impossible, for myself anyway, to participate in. And it did begin to tighten up over here. Just where we see this red bar being ignored. I don't know what's over to the left over here, but we do see that there was a breakout on a wide range bar that winds up failing. And then prices eventually, they trend down or break down under this major support area. And so now we've got a declining 20 MA under the 50. And it's not that we're interested in the moving average crossover here. And moving averages are visual aids that help speed up the analysis. So I can recognize the fact that this is broken down, but as I'm flipping through my scans and looking at pictures, I do recognize that the 20 is under the 50, but the 50 is flattish here. So it's not trending down over a longer period of time, where it's just getting started. Because here, where they're trending down together, we know that now the trend is underway, and it should continue to go lower. Now, once this broke through multiple points of major support, well, you're looking for short sales in areas of resistance, and the 50 MA does become, and can become, I should say, a self-fulfilling prophecy. And when it reaches that reference point, we can see that there was a breakout failure that occurred over here, and it turned into topping tail bars, and that is bearish price action that tells us think short. Doesn't tell us it was going to gap down. So I haven't gotten to this yet, but I'll mention it that You need to be aware of news and earnings reports. So while we've got this attractive pattern to sell short here, it may have been reporting earnings that happened on this day, which would suggest we really shouldn't be short because it could have gapped up and went higher. So something to keep in mind, that news events could keep us away from what could be a pretty attractive pattern. Now this retest pattern that's happening down here, that would certainly catch my attention, but not for a swing trade. It's below all the moving averages. The 20 and the 50 are pointing lower. So while it has stabilized in this area, what I'd be more interested in is, does it go sideways over a period of time and form something like this where I could short it? And what should it be checked? Well, you know by now you're looking to the left to see if there's a price void. Now, this aside, and it's a different subject, but this type of price action where it's retesting that low, while I wouldn't be interested in this as a swing trade, it certainly could set up a put spread, right? So we could look possibly for a bullish put spread for an income trade, but only with short time to expiration. Meaning if I could see this pattern and find a spread where we could take in some money and say, hey, do I think this would stay above this level over the course of the next 5 days? That would be a reasonable thought, because I'm still looking for this to go sideways over a period of time before I would even consider it as a short. And like, if this was in an area of support on the weekly time frame, maybe it could be a bottom, but that's not our focus here on this slide. But just wanted to mention that these kind of patterns, while the expectation based on what's explained would be lower, they do become put spread candidates in our weekly options trader, because it's a very short period of time where we're looking for it to hold. Now, what we're looking here is a weekly time frame. It's making higher highs and higher lows. We're looking for buy setups. As mentioned, the 20 MA is pointing higher, so we know that the 100 MA is pointing higher on the daily time frame. So let's go take a look inside of it. And here is the same chart, the daily time frame, and I've got a 20 above the 50. Both are pointing higher, and I've got this very nice retest pattern that is forming down here. Right? Note the bottoming tail bar that took out the lows, and it moved back up again on the retest. You had that nice volume spike as it pushed up, and look how tight the moving averages are here, which tells us that this is really just getting started. And they were a little further here where there was a move up and it corrected down, and then it consolidated, and then that gap up on increased volume, and then the pullback where it tests the rising 20 MA and the area of that prior low. Great setup as a swing trade, expecting prices to go higher. 20 and 50 rising. We've got a retracement into the rising 20 MA as it's pulling back, and I really like this type of a pattern. I talked about this kind of a pullback here, this angle of retracement, and how this builds up an area of support. And as we talked earlier in this section, how multiple days going sideways can create a basing pattern on a smaller time frame where you see downside shakeouts, which are these bottoming tail bars. But on this time frame, I really only need to see the fact that the trend is up. There was a powerful move up on increasing volume. It's pulling back into the rising 20. The 20 is above the 50. These bottoming tail bars telling me that there are downside shakeouts that are happening intraday. And this little sideways price action that is occurring there is building a base for prices to move up above. You might be saying, well, Greg, what about those topping tails up there? Well, trend and powerful moves are respected more than a prior high. And this type of bottoming action, these bottoming tails, are helping to dissipate the potency of this area and the potential supply that'll be there. So when we look at an uptrend, we give the benefit of the doubt to the trend, and pullbacks with this type of price action are supportive that prices should go higher. Now, clearly prices stopped there and they went sideways. What are you looking for? Price action in that area. Bar by bar analysis. Red bar being ignored. Bottoming tail bar. That tells you everything's okay. No doubt the red bar gives you concern on that day, but on the next day, it's dissipated. Right? So the price action is bullish there, and of course that resulted in prices going higher. So there was your entry as it traded above the red line, stop goes below the green line, and then you go into management mode to see how the trade's going to play out. Another basing pattern, and in this example, prices get a bit extended, but look at where they started from and how the moving averages are close together there. And here's a volume spike. There's a big volume spike as prices move out of the base, and we get two wide range bullish bars that result in a sideways consolidation at the top of the wide range bar, with topping tails being ignored, more bullish price action, and then as it gets somewhat extended from the 20, it just continues to go sideways there, and red bars being ignored. So as we look at this, we have no reason to believe it won't go higher based on what we have here. I'm repeating, but of course you're always looking to the left, but 20 is rising above the 50. I don't know where the 200 is, but I'll tell you, if I saw the 200 right here, which it's not, but if I saw it there, it would give me pause, because that tells me that the 10 MA is declining on the monthly time frame, and I should take a look at that. Short review, right? Our primary time frame, our daily. It's got to be trending up, down, or sideways. And if it's sideways, I'm not too interested, unless it's a bottoming process or a topping process, because my primary focus is trending setups, either up or down. So that time frame above your primary, we want that to be aligned as explained. We explain transitions from red to green and vice versa. Right? They have to be relevant in your primary time frame. Is it at an inflection point? Is it at minor support? Is it at major support? So we're always combining trends, support, resistance, and patterns. Right? Wide range bars in that higher time frame is going to be a momentum move in a lower, and that creates a price void. Failures, they start in a lower time frame. At this point, you have an understanding of multiple time frames that will take you to wherever you want to go. Understanding of this and the combination of these concepts, putting it all together, and it says you're becoming a master trader. You have information here that is not based on subjective information. It's price information that's being created by everyone that's trading, and you're able to recognize that objectively with the concepts that you've learned. Let's continue to the next section and continue to put this together. Let's move on to another key to success, and this is a big one: position and money management. The best technical analysis and strategies are not going to make you money in the long run without money management rules, and they have to be enforced rigidly. So I think you already know this, but a 50% loss in your account requires a 100% gain to break even with the money that's left. It's a big point to recognize, and why money management is so important, that you take calculated risks as a major key to your success. This is a business. It's not a hobby. If this is entertainment for you, well, that's all well and good, but still no reason to be risking more money than you should. Do it intelligently. And I do have subscribers that call and tell me that they enjoy doing some trades and credit spreads because they're retired and keeps them busy and something to do. That's fine. But don't be looking to swing over the fences. This is such a big key, and I can tell you from experience, it's one of the ones that the majorities just pay attention to last. The technical analysis part is certainly more interesting. It's what will make you money when you understand it and do it correctly. But without the money management part, odds are you're going to lose big at some point and you're not going to make it. So this is how most approach it at the beginning, meaning I'll just buy 1,000 shares per trade or 2,000, whatever it might be. Or are you going to risk $1,000 per trade? And as you start to look at money management closer and start thinking that, hey, this isn't gambling, and I'm doing this intelligently and taking calculated risks, I think, well, maybe I'll risk 1%, a half of 1% of my account per trade. And as you take it further, I'll risk 1/4% per trade and 1% of my account per day based on Master Trader Strategies plan. Now we're getting smarter, and the calculated risks are just that, more calculating. So let's talk about how doing it. Well, the first thing to do is determine the amount of risk, dollars, we're willing to risk per trade. So we refer to that as R for short. Now, with consistent losses, and obviously the goal here isn't to be consistently having losses, but the goal is to have losses, the amount that you do lose in losing trades, to be consistent. And by doing that, having calculated risks or losses, you're never going to blow up your account in 1 or 2 trades. As swing traders, by definition, we are holding positions overnight, which does come with that overnight risk. And I did mention in a prior section that I don't trade biotech stocks, but do trade biotech ETFs. One of the reasons is that the overnight risk can be sizable. Yes, it can be this other way, with the upside being huge as well. But biotech stocks with a bad report on a particular drug can gap down 30 to 50%, and I just not willing to take that calculated risk. So I don't trade them. Can other stocks gap down significantly? Of course. But that's primarily related to earnings when they come out and they disappoint. We know when earnings are coming out. So we choose, if you not to hold over earnings, that's a way of eliminating that risk. If you're holding a position longer term, which isn't swing trading, and you're holding on, there are different option strategies that you can use to control risk and increase, or I should say decrease, your cost covered calls. Different option strategies can be used for longer term positions. It's about planning. You determine the amount of risk per trade, per day, per week. And psychology is so connected to this, in that when you use proper money management, I can't tell you that there's no stress, because there's always some element of stress because of the unknown that comes with trading. Whether it's day trading or swing trading, we don't know how the next bar is going to form. But when we're taking calculated risks that are acceptable to our account size, that stress is reduced exponentially. So how much are you willing to risk? What's your maximum amount of money that you can lose on a single trade? $10, $50, $300, $1,000? You might say, Greg, $10 is ridiculous. I have had students that have blown up their accounts, accumulated small amounts of money, and started over again with $10 risks, and eventually became successful. So even if $10 or $50 means nothing to you, realize that you're in the learning process, and just make the trading about getting experience and assimilating the information that you've learned here, and take the money part out of it. And eventually, as you gain that confidence and discipline and patience in yourself, then you start increasing your risk based on your account size. But in the beginning, make the money meaningless. Here's a example of a table that you could use for calculating your risk, where you might say, I have a $100,000 account, and I'm going to risk half a percent of that capital, and my maximum loss per trade is $300. So $300 times 4 losses in a day, $1,200. 4 losses, I don't trade anymore. We're done. And so we need to calculate that size based on the stop loss. And in this table, you can see how the smaller stop loss allows me to increase the share size. So in the middle there, based on 40 cents divided by 300 shares, it's 750 shares. So with that being said, you take whatever it is that you're going to risk based on your stop loss. And now you can say with different trades, this trade has a 70-cent stop. This one has a 20-cent stop. Maybe it's got a $2 stop, as a swing trader, especially with stocks that are $75, $100, maybe $150 a share, and they have those bigger stops. You doing less shares, and don't shy away from those stocks that are $100 or $150 because you're doing less shares. Why? Because they have the potential to move $4, $5, $6, $7. So smaller share size can add up to a lot of money in those higher priced stocks. Now we want to determine the risk based on the chart. So while we're saying that our stop loss is going to be based on a technical chart pattern, meaning here is my entry point above the red line, which is the high of that green bar, and our stop is below. If for reasons being maybe the pattern such as this one as it's shown, and we talked about this in the prior section where the bars came down with lower high, lower low bars, and we talked about how prices came down in a smaller time frame, that it would be trending, right? We talked about that in a smaller time frame. It's trending, and while I love this pattern as far as a wider range bottoming tail bar, and if it had an inside bar the next day, I would like it even more because of the explanation of that sideways consolidation on the lower time frame, and those time frames coming into alignment, and then the trigger. Great. And now putting the stop below here makes absolute sense. However, let's assume that the pattern is one in which it's just as it exists right now, or maybe even it doesn't have this bottoming tail bar, and it just got this 2-bar 180 type of reversal. Well, at that point, I might consider a bigger stop and saying, you know what? Well, 15 cents sounds great, and more shares to make more money to target. Well, maybe under a certain condition based on the pattern, the market environment, whatever it might be, I'm deciding to double my stop loss and reducing my share size. And because at that point, maybe it wiggles and I'm still okay. And I'm sitting through that because the major trend is up and it's above major support. So that's a decision that you'll make as time goes on based on the patterns that you see in market environment, or just you're in a learning process and you're saying, well, you know what, I'm going to give this thing a whole bunch of room and see what it does, and I'm going to do 60-cent stop with 500 shares, and let's just see what happens here. And if it pulls back to this point, no big deal, and then we could observe to see what it does, and so on. Oh, reviewing what we've already talked about and what we see here on this particular stock with these moving averages the way they are, well, here's an example of the 20 MA intersecting through the middle of prices. I'm not interested at that moment in time. However, looking at what's happening bar by bar, I can see that this is in a bottoming process above its 200-day moving average. And we're always looking for what I would call an event. What's an event? It is a bar that occurs within the context of what preceded it that says this is a moment in time that's key and that prices are likely to start moving for reasons of that event. And in this case, there was this bottoming tail bar that was a big red wide range bar, so a range expansion bottoming tail bar. And those are powerful. We covered that in the candle section. And so this is where prices are just starting to turn up again, and it's the beginning of a move. And I like this pattern. And as it says, 99% of our entries are going to trigger by trading above a prior bar's high. Now, with that being said, if I was to see a very compelling pattern, such as this, with a range expansion bottoming tail bar, I might decide to put on an initial position at the close of trading, or very close to the close of trading, where I know that that bar is going to close that way because we're near the end of the day. And I'm going to hold that overnight, and I'm going to give it room. And initially, our stop would certainly be below the low of the bottoming tail bar. But because it hasn't triggered yet, maybe I would increase the stop loss a bit and take on even less shares. That is certainly a choice. But this is a very attractive pattern. And looking at the pattern, say, well, and this is a question that often comes up, so why I'm saying it is, it'll often be asked, do I have to wait for it to take out that high? No, you don't. And the reason being is because this pattern is one that says that high is going to be taken out. So you don't have to wait for that. You'd be having a bigger stop, and we've already got enough information that says prices should go up. So when we buy pullbacks within an uptrend, and this isn't an uptrend yet, but it's a pattern that says it's going to start moving up, the assumption is that it's going to take out the prior swing high. This isn't a swing high, but the pattern is one that says the high is going to get taken out. And even if it's not taken out immediately, and as you can see, it wasn't, our stop is down here. So whatever happens, and it could have been another bar here, and then it eventually went up, we really don't know how it's going to play out. But we look at the overall pattern with the concepts that we've covered, and we make an educated assumption about what's likely to happen. And in this case, we had a big rounding bottom. You could look at it bar by bar, and this event that happened right there says it's going to go up, and our assumption would be it's going to come up to there, and then we would trail, and that's what we're going to talk about next, about how to trail this as it begins to move. So once you've gotten into a position, clearly we would like to make as big a gain as possible. But to do that, we're going to have to let prices correct, meaning at times we're going to have a profit where if we would have closed the trade out, we'd have had that money. But our assumption is that based on the pattern and bigger picture analysis, that prices have the potential to move even higher, so we're going to have to let it wiggle. We don't know the extent of the correction, so we're going to have to give back some of the gains, not literally giving them back to where they're gone. The assumption is that what we could have taken, we're not, and we're just going to let it correct a bit, and it's going to move higher. So we don't know what's going to happen, and there's just no way around that point because none of us know the future. So if the stock hasn't reached an area of supply, resistance, or demand yet in a downtrend, the odds are with you. How are you going to do it objectively? Well, we're going to do it in a very systematic way. So our first reference point of demand or support in a long position is a prior bar's low. And from there, we're going to see if it forms a pivot. So that second reference point of support or demand in a long position is the prior pivot low, or that swing low, as we've defined already what that is. So if we're long and there's a price void, we're going to hold on to part of that position even if it violates a prior bar's low. Now, at the beginning of a move, right, we don't want to stop out under a prior bar's low immediately because that just wouldn't make sense. Prices haven't really started to move yet, and the pattern hasn't developed enough yet. However, if we get into a position and it just accelerates higher immediately, let's say it goes up 3 days in a row, 4 days in a row, that's fabulous. So if that was to happen, well, it'd be okay to sell half below a prior bar's low, and then we're just going to let it pull back and pivot and go into what I would call intelligent hope mode, which means I hope it doesn't go all the way back down to my entry point and that demand is strong enough to where it can create some support and prices wiggle around, maybe they pull back a bit, and then they overcome that prior swing high, and now it's formed a new pivot, or what we refer to as major support, and then we'll bring our stop up below that prior swing low. So once that's happened, we're then letting it move, and as long as it doesn't go below that, and then we're going to just, ideally, it's either going to accelerate higher or it'll move higher and then pivot again where we can bring it up under the next pivot. And then if it does accelerate, we'll then begin to trail stop under a prior bar's low again. Here's an example of exactly what I just said, where we're getting into a position, right? So there's your entry point, and we're assuming it was at an uptrend, let's say at the 20 MA, and we've entered, and prices accelerate higher, bar by bar, very nicely. So we bring our stop under a prior bar's low. For half of the position, you may decide that you're going to sell a third of the position based on multiple time frame analysis and a price void, and maybe the markets have just come out of a bottoming process, and we haven't talked market internals yet, but they've just given you a recent buy signal, so maybe you decide you're going to only sell a third. You'll decide that at the time. And then prices pull back, and you get a pivot, as we've defined, a pivot, 3 higher low bars to the left and the right, and then it overcomes the prior swing high. So now your stop has gone here, and now you're just waiting to let it pivot again. And as it reaches closer to your target and begins to accelerate higher, you then begin to trail prior bars lows again, and so on. So it becomes a systematic method of management, and you just do that, and the odds are in your favor under this scenario because of everything that we've explained already. Target area, it's going to be based on some reference point of resistance over to the left, unless, of course, we are in a position that's making new all-time highs or new 52-week highs that are still within a price void. So whatever that target may be, it could be just based on prior swing and saying, well, this swing from here to here was 5 points, and so we're just going to look for like a measured move type of concept where that would be our target area to sell half or trailing prior bars low when you're 80% way to that target. Or you sell another third and then just let it pivot again. We haven't talked about this particular concept, but one in which you might be using relative strength and relative weakness to where, as prices moved up, you then you're reviewing what's happening, and as they're moving up and you see a wide range bar at that point, and possibly the broader markets at that time had pulled back, and they're coming up to an area of resistance where odds are the markets are going to stall and begin to pull back, so you begin to tighten up stops. So there's different scenarios just based on the price action itself, or we could use the relative strength, relative weakness concept, even one in which where the market has moved up as it has, and maybe your stock is sitting here at the prior swing high and it's shown relative weakness. So there are going to be methods of evaluating what's happening based on price as well as the concept of relative strength and relative weakness. A review on protective stops. Here's a start with a definition. The point where you've predetermined the probability of the trade working in the direction originally intended no longer exists. So you exit the trade. Simple. I thought something was going to happen based on our analysis. It's not happening. It's not what I expected would happen. An event happened that was unexpected. So I exit based on my calculated risk and stop loss. And that's going to be based on price, meaning support or resistance. Is not a dollar stop to say, hey, I'm willing to risk $100 and I'm going to place this trade. And let's just look at an extreme here and say, hey, here's this stock that's trading at $340 and I'm going to risk $100 and take on 1,000 shares. Well, you're going to be stopped out probably in the next few minutes. And you can see why that's just not a smart thing to do. So once you've entered there based on the technicals, well, you've accepted what it is based on the chart and your reward to risk and your calculated stop and so on. So it's just one trade in many. And then we go into trail stop mode as just explained, where we're raising the stop after an accelerated move or a pivot has formed and that's been established, and we go into trail stop mode. And as prices accelerate from a prior swing low for longs or a swing high for shorts, momentum is increasing, we then raise our stop above or below the prior bar. So the stops, we have to recognize them as being what's required to be in this business of trading. They protect our money. You have to recognize them as, I'll say, a friend here, because they're protecting our capital that keeps us in business and making more money, and just accepting the fact that the future is unknown. The odds are in our favor, and that if it doesn't work out, we step aside and we move on into the next trade. It's as simple as that. Danger of dollar counting. It's not your money until you exit the position. So don't be counting or spending unrealized dollars while in a trade. It's not what you should be focused on. What you need to focus on is the chart, bar by bar analysis, the way it's explained. And it really makes it rather simple as to what we're doing when we put together the concepts that we've talked about, where they come together and we see this opportunity that the odds are in our favor. We take our calculated risk, we enter at the appropriate time, and then see what happens next. We've got a plan. Our job is to stick to the plan. Why you might be focused on or thinking about the money? Scared dollars, which would be normal, to think about what's happening there and maybe not focused on there. Too big a position size. If you're thinking, what if? Well, you're never going to answer that question because no one knows the future. So why even ask the question, what if? There's no answer to it. If you bring yourself back to the concepts that we've talked about, and you're using that discipline and patience that you've acquired through experience and trading smaller positions, you're not going to ask that question. Well, what if you just don't have confidence because of a lack of knowledge? Well, you have the knowledge now, but that doesn't mean you really, let's say, know it, in quotes. Just because you've heard me explain it, that doesn't mean you know it. So maybe you need to listen to this again and again, and then go to your charting platform and look for examples and print out those charts or capture them in Microsoft OneNote and mark them up and do some audio recordings of your own, recording your thoughts and going back and reviewing what you've captured again. And through that practice, you will have the knowledge, and then you just have to experience it, not trusting that you'll do the right thing this time, meaning press the button and enter the trade or take the stop loss. So being uncertain about your own actions obviously is not a good thing. And so with the answer to that, paper trading or very small position sizes where the money doesn't mean anything. So you can start out paper trading, you start out with small position sizes, and you build up again, and there may be a point in time where you run into a rough patch where the market becomes choppy or you take several losses in a row. Well, go back, and meaning smaller position size again, and reevaluate. You shouldn't stop trading, meaning you should always be selective in what you're looking for, of course, but there are points in time, as I said, the market gets erratic, or maybe you became overconfident and you started taking on positions that weren't part of your plan. So there are different variables that'll happen within the market that comes with experience, that you'll be able to adjust and recognize the things that you're doing yourself when you're not following your plan. Too large a position, well, that's an easy one, because when you start associating money management with psychology, all you need to do to recognize that is just put on a big position and watch how you start to worry, and get nervous. So the position size should be based on the money management, as already explained. Anything can happen. Always have two scenarios, which means here's my setup, here's my entry, here's my stop loss, here's my target, and the stop loss, having one already plans for the second scenario of the trade didn't work. So no matter how bullish or bearish it is, you're open to those other possibilities, because there are no guarantees. As much as we can put the odds in our favor, we never know 100% what could possibly happen. So why not consider other possibilities, even opposite of what the chart suggests? Why should you do that? Because it can happen. We don't want to confuse the matter by saying, the what if. But what if scenario is calculated into already what your stop loss. So it doesn't have to go any further than that. You've thought it through enough because you've already calculated your stop loss and you've put that in place. So, you move on from that. Overcome the temptation out of acting prior to information needed, out of fear of missing the trade. These are called impulse trades. How do you know you did an impulse trade? You go back and review your trades, and you come to the conclusion as you look at it, and you think to yourself, what did I see that made me press the button and do it? That's an impulse trade. Overcome the temptation out of fear that prices are going to move against you, rather than your plan as explained as to trail stopping, or maybe a big gap up in your favor where you're selling that position because of the gap. A market internal being at an area of resistance. Well, we haven't talked about internals yet, but you may be in a position where it's gone in your favor very well, and now the internals are warning, hey, there's risk for longs here, so tighten up your stop. But unless you have information to suggest that you should exit a position, that in of itself is an impulse exit of the trade. Now, patience and discipline will come in time as you apply the techniques that I've been teaching you here. And it is the biggest challenge because, as you've already heard, psychology is a huge part of what we do. And through money management and experience, you'll gain patience and discipline. And if you don't, you won't be doing this very long because you'll probably incur some big losses if you're not applying, especially this section, and of course, taking trades that make sense based on what you've learned. You've got an objective method here. You've got some great information. Now it's up to you to make it your own. Advanced Money Management course delves into this much deeper. And as a swing trading student, I've provided you a coupon code, as you can see here on the slide, AMS Master. And if you apply that into the coupon code box that is there on the checkout, it'll take $300 off of the cost of Advanced Management Strategies. Let's move on to the next section. All right, let's talk about top-down analysis. And this is my approach to the markets, and always has been, is that the broader markets move the majority of stocks. There are stocks that are said to be on their own page that'll outperform the markets, of course, and there's certainly a lot that will underperform the markets. But the top-down approach is one where we're saying, Here are the broader markets, and they're going to influence the majority of stocks. So let's see the direction of the broader markets. Let's compare various markets to another, if they're in agreement or not. And then from there, let's take a look at where money is flowing into and out of various sectors. Some sectors will outperform, others will underperform. And then we can look at the stocks within those particular sectors to see which ones are the best performers or underperforming. And by taking this top-down approach, by the time we get to the individual stocks, we're going to be finding the ones within the markets that are the best, meaning they're in strong uptrends, they're outperforming, they're likely to continue to outperform. And that is the concept of relative strength, whereas a particular sector is outperforming the broader markets, and a particular stock within that sector is outperforming the sector, and that is where the money is flowing into primarily, and that should continue. And that's the assumption of the concept of relative strength, and the concept of relative weakness is just the opposite, and that what's weak should continue to be weak. And unless we're looking for short sales, right, we're going to avoid the ones that are showing relative weakness to that particular sector and the broader market. So let's take a look at the concept, which I believe is relatively simple but powerful. And this is, what I do every single day and week. So from a daily perspective, day to day, it takes a relatively short amount of time, and the software that I use to do that actually makes it extremely easy and fast to do. But as you start to drill down into the individual stocks, of course, it's takes time to get through that. But as you'll see, the software really does accelerate the whole process. Where years ago this had to be set up manually, which was extremely time consuming. So today things have gotten a lot easier, of course, through the internet and because of technology. But let's take a look. So what we're doing is taking a look, as I explained, at the broader markets and then sectors and then stocks, and we're taking a longer term view and an intermediate term view. So as we look at those broader markets, we review them, we take a snapshot, if you will, just taking a look, and you'll see how I set this up. Are those broader markets moving up, down, or sideways? Is the S&P moving up where maybe transports are sideways or moving down, or vice versa? And we can start to come to some conclusions just from that as to the health of the broader markets or the lack thereof, and where we might want to put our focus. Now we then look at sectors, individual sectors, and as you'll see from the scanning, we can review really quickly to see which ones are doing better than others. And then from there, we start to look at stocks within those particular sectors of interest, and we review them. And then we're going to look at our market internals, and I'm going to give you a really easy, quick way of monitoring or timing the market here that I've used for decades. It works really well. It's simple, it's easy, and you can set it up so easily and monitor it on a day-to-day basis and week-to-week basis at the glance of an eye in a few seconds. So let's go ahead and let's get going. So I look at the broader markets in this way, and if you're a advisory letter subscriber, you'll see this chart every single week, and I'll review this in multiple time frames, weekly, sometimes monthly at the end of the month, and of course the daily, and I'll look at the trend of these broader markets and which are outperforming the others, and I'll look at them on a bar-by-bar analysis. Are there failure patterns there which are confirming the trend? Are there breakout failures which create uncertainty? So everything that you've already learned, you would then apply to the broader markets, even if you're not trading them. However, you do have the opportunity, because these are ETFs, to where you would say, hey, here's an opportunity where the S&P 500 is pulling back to an area of major support, and the macro time frame is up, and bar by bar analysis says that this should continue in the direction of the prevailing trend. So I'm going to buy SPY, or it might be QQQ. Sometimes the Russell will outperform. Sometimes it underperforms. But with the tools that you've already acquired in this course, you can come to really intelligent conclusions as to what is outperforming and underperforming, and whether you want to trade the broader markets or continue the analysis further down. So this is a minder that I created. It's easy to do, that you can create it. And this is platform, it's called TC2000. I don't have any affiliation with them, but I have been using it for an extremely long time. And I'll continue to explain why. But it's really easy to use, and creating some scans in it are relatively easy compared to what I would consider very difficult in something like TC2000 or eSignal or any other platform. This is about the easiest you're ever going to find to create scans. And as a student of Master Trader, I do provide these scans to you free of charge by emailing me through the platform if you have it. Okay, so this is one of my minders where I'm looking at the cash markets and seeing what is the percentage change on the day, what is it over the course of a week, what is it the course over the year, what is the net change, what is the weekly change, and what is the range. And that helps me come to some assessment as to what's happening in the broader markets. Of course, I'm going to look at the charts and compare just as we did on the prior slide, but this is where I'm looking at a comparison of these broader market cash indices as to how they're performing in relation to each other. Now, as we start to move further down, I have a whole list of different ETFs. We're looking at those, and in this minder, it's just sorted by net percent change on the day. And you can set it up the same way as that prior minder of percent change on the week and on the year, and so on, to see where money is flowing into or out of on any given day, or on a week, or on a month if you choose, and of course on the year, to see how each of these sectors are doing. Now, this is the starting point, meaning just because something like biotechs are up at the top of the list on this particular day, that doesn't mean they're in an uptrend. They might be coming off of a bottom. They may be in a downtrend and just had a good day, which we're really not interested in that, because the trend is down. So, as I said, this is a starting point to see where money is flowing into or out of on this particular day, and then we look at it on the week, and as already mentioned, we're looking at the particular charts and comparing relative strength and weakness and trends and support and resistance, and we're looking for what's had big moves. These next slides are examples of those ETFs that are related to that particular sector. So we look at financials and businesses that provide financial services, of course. And then there are different ETFs related to that. So XLF is a broader ETF where you have the bigger banks in there and brokerage firms, and XRE are the regional banks, and they can be vastly different from each other, even though they're both financial. But from that ETF, we can then move down and look at the individual stocks within it, and then do the same thing as to sort them by daily, weekly, look at the charts. That's the process. Technology, as explained there, and you could read, XLF is the ETF, and the platform mentioned, TC2000, breaks it all down for you. Meaning and you'll see that in one of the upcoming slides, when you set up the page that way, if you look at the XLK ETF, you can set up a minder that will populate all of the stocks that are in that ETF. And that's what you're seeing on this slide over to the right, where I've just captured some of those particular stocks, and there are more. And you can sort that by volume, by price, by percentage gain over time. So it's really powerful software and the top-down approach is a powerful one, and where you could really begin to zero in on where the money is flowing into or out of, and then applying master trader technical strategies as to the appropriate entry points that put the odds in your favor. What more can you ask for? And so let's continue. All right, so consumer staples, businesses that are creating and selling products. I'm just saying Coca-Cola, Walmart, retailers, and Kroger, and so on. Campbell Soup. Now, sometimes these are so in favor, and it's interesting when they're not, that why aren't people buying what are considered staples? Why are you're buying soda and food and ketchup and soup and so on and so forth? And that at times is a pretty strong indication about consumer sentiment and the economy, or the lack thereof. Basic materials, chemicals, metals, and agricultural. So sometimes these do tremendously well, and sometimes they don't. Again, we're looking for where the money is flowing into and out of, so we can participate intelligently in that particular sector. There are going to be times when a sector will outperform or underperform, and we just approach it intelligently as explained to take advantage in either direction. Oil and gas, going to be influenced by the price of crude oil, of course, and natural gas, and there are various ETFs for that. XOP and XES are focused more on oil and gas, while XLE is more about just oil, and OIH is about refiners. So we can zero in on these different ETF where there are like subsectors within those sectors, which they're going to primarily move together, but at times there are differences. And again, we can move down to the stocks within those particular sectors to take advantage of the ones that are outperformers or underperformers. If this particular sector is underperforming and we're looking for short sales to take advantage of that, we can short the ETF, or we could find the weakest stock that maybe is in a downtrend, and then it went sideways and it's formed topping tails and it's got a void below, and we're shorting that one. So we have a lot of different options as to what we want to focus on and trade either long or short. Industrials, businesses that are producing goods, using construction and manufacturing, and XLI is the ETF for that, and you can see the stocks within it. And some of these will do extremely well. So, for example, Boeing is actually part of another ETF called Aerospace and Defense, and that has done very well, whereas GE has done terribly. So these ETFs and the stocks within them provided diversification by definition. Your job is to find the best of the best or the worst of the worst and take advantage of them with the tools that have been provided. Healthcare, you've got the various ETFs to take advantage of that. And this is a pretty diverse sector as well, where one sector, say pharmaceuticals, may not be doing as well as XHE. So you would obviously look at these and see, again, relative strength and relative weakness. Consumer discretionary, which means, hey, I've got the option to buy this or not. I don't need a new pair of sneakers, but if Nike's doing well, maybe I want to buy Nike. This sector may be doing well, and Nike may be the best performer, where Ford and General Motors are doing terribly. But if I'm trading the ETF, again, I have that diversification of taking advantage of the good, not being affected so much by the bad. It's going to have an effect on the sector, but I'm not going to be as affected as someone that's buying a particular stock that's in a downtrend and out of favor. And I'm not going to do as well as the person that bought the stock that is in favor and doing tremendously well. But, we've got both sides, the good and the bad. And diversification is about not being exposed primarily to the bad. Telecommunications, utilities, you've got the idea at this point as to what we're looking at and why and how to take advantage of it. Internet, which is a huge part of the market today. The ETF is FDN. You can see the stocks within it. Snap, at the time of this recording, looks terrible, like you could possibly think it's going out of business, whereas PayPal is doing tremendously well right now, and those trends can change drastically over time. We all know of Amazon and, of course, Netflix, and exposure to all of them by buying the ETF gives you that diversification to be able to participate in them without the downside of a Snap, and to some extent right now a Twitter. Right? And retailing is obvious. Here is your retailers, and Amazon is in there as well as the internet. And so there are different stocks that are going to be in multiple ETFs, and we get to own those great stocks. And of course, we're getting exposure to the not so great ones, and that's the advantage of ETFs. But the top-down approach is one in which we get to choose what we want to do, right? What we want to participate in. I can participate in buying the broader markets and picking the best one. I can participate in a particular sector ETF by picking the best one and avoiding the worst one, and I can look at the stocks within it. So it's a great approach to the markets, and utilizing the software as I do makes it relatively easy. So the minder on the top right is the S&P Spider Sector ETFs, and they're listed there in that minder, and I can look at, as it shows you, percent change on the day, on the week, on the year. And I've created this minder so I can see if they're near a 52-week high, or is it making a 52-week high. So through different views of this minder, I can see what's strong and what's weak over time. I like to look at the cash broader market indices, as I've already shown you. Those are the ones that are primarily quoted in the media. So, and even just reporting as I do in the advisory letter, this is a help doing that. And then the broader market in these ETFs is already explained on the prior slides. And the great part about this platform is that if I click on FDN, that ETF, the minder on the left is going to populate with the stocks that are in it. And I've already explained to you, I can set this minder up with different percent changes over time and sort this minder and look at what's outperforming today or underperforming, or what has outperformed or underperformed that particular week. And on the year, I can sort it by volume. I'm not interested possibly on the low volume ones. And as you can see, the earnings reports are in that minder. So as I look at these, I can see that, hey, this is going to report earnings this week or tomorrow, or maybe it's in a few months, but I'm aware. And I can sort that minder by earnings dates. So during earnings season, by sorting that, well, now I automatically know what's reporting earnings tomorrow, next week, next month, and so on. So being aware of that is vitally important. So it's a great platform that enables me to do a lot of work in a relatively short period of time and sift through, the markets, sectors, and stocks within it. Now, market internals. Right? These are the market internals that I've used for decades, and I've looked at many others as well. And some may be helpful, but it can become overwhelming looking at all of that. So I've zeroed it down to these two. and it looks at breadth. What's the participation of thousands of stocks in the market? And while the concept of overbought as it relates to an oscillator is irrelevant, as it relates to the broader markets, it's important. But all by itself, it's not a reason to act. Meaning, what I have found is that the important points in time are when breadth and sentiment are in agreement. So what we're looking for is when the broader markets have reached an extreme move to the downside or the upside, and sentiment, which is based on the equity put-call ratio, is also at an extreme. Now, the breadth is based on what's called a McClellan oscillator. And all that is if you're looking at advancing stocks minus declining stocks, and you were to look at that squiggly line, that EKG of advancers minus decliners whipping back and forth, and then applied two moving averages, which, if you're familiar with what's called an MACD indicator, all is that doing is looking at the difference between two moving averages. And that is what this McClellan oscillator is doing. It's looking at the difference between the 19 exponential moving average and the 39 period exponential moving average of that advance minus declines. And it oscillates back and forth between the 100 to 200 area, meaning plus or minus 200. And so what we're looking for is, you can see in the green boxes, when it moves down below minus 100, in between minus 1 and 200. Sometimes it'll get down to minus 300 during an extreme move. And historically, markets will bounce pretty soon after it gets down there. But that powerful move is a warning shot across the bow, where it was a pretty powerful move. And you can see that was a powerful move to the downside. But at times, the move price-wise will not be as extreme as what you see on this example, but you'll see that McClellan oscillator move down to that low level. And while we would look for a bounce, we want to pay attention when if it goes down to that minus 300 level. The normal areas, down at minus 100 to 200 or up above plus 100 to 200 would be considered, the normal levels that it would move to. But our focus is going to be when sentiment and breadth are in agreement. So that put-call ratio, the static extremes of too many call buyers versus put buyers, call buyers being bullish bets, put buyers being bearish bets, 0.80 is the extreme where there's too many calls versus puts, and 1.2, too many puts versus calls. Now, this can move day-to-day extremes, and from a swing trading perspective, that's really not our interest. From a swing trading perspective, I'm interested in when that sentiment moves to an extreme based on a 5-period moving average of those closing levels. And what you can see here is that I put these envelopes around that moving average. So the way to create that is to put a 100 MA of the closes. You don't see it on the chart because I've just blocked it out. And then you create this envelope, a 10% envelope and a 20% envelope around that 100 MA. And it creates this envelope which will adjust your levels for bull and bear markets. And it works. I've used it for decades, and it's an excellent way to make adjustments for market environments from the static levels. Now, those static levels can still be reached in a bullish market, whereas, it may not get up or get all the way down to the 1.2 in a bullish market, but it'll reach the bands, and vice versa to the higher level in a bear market. So it helps to make adjustments for that. But our primary focus here is when they're in agreement, they give us short-term swing trading signals for either there's risk for longs in an uptrend, and when there is greater opportunities during correction in a bull market. So, market internals, in addition to what I've shared with you already, just increasingly is putting the odds in your favor, and you can see the accuracy of the turning points when they reach bullish levels or when it reaches a bearish level. You may have heard of the term of a yield curve, and it's simply looking at the difference between short-term interest rates and longer-term interest rates. I use the 30-year and the 3-month, the two furthest extremes. Some will use the 2-year and the 10-year. I've looked at both. They pretty much move together. So you're really not getting an advantage or disadvantage of one versus the other. They're going to, move, pretty much in lockstep with each other. So what we want to look for here is when there is the risk of a big bear market. And that occurs when you have inversion, where you have short-term interest rates above long-term interest rates. And this just plots this and gives us a very clear view of when that has happened. And so if it gets below 0.5, I'm saying, hey, that's something to be concerned about. Now, the lag time here is pretty long. And you can see where, and back in 2000, where it had gotten near inversion, and then in inversion, it took a while before the market started to move lower. So just knowing that ahead of time is a huge advantage. Don't expect this to be pinpoint accurate to where it reaches an inversion and then you get an immediate turn in the market, because historically it just doesn't happen that way, but it's extremely accurate. And then when it gets above 3.0, that's extremely bullish, where the spread between those yields are historically very wide, and the bottom takes a while to form as well, but we've got objective information that provides us think buy here. And then we're going to wait for that price confirmation, and we're also going to rely on breadth and sentiment and everything else that you've learned here to put it all together, to be objective, because during corrections, we really don't know how low it's going to go. Right? We have the tools to determine bottoming type of price action, but bottoms are erratic by definition. They whipsaw, but as we're seeing these internals coming together, we know that the odds are increasing that the market is reaching a turning point, either bullish or bearish. Then we're looking for price confirmation. We're looking for breadth and sentiment confirmation. We're looking for multiple time frame confirmation. And odds are we're going to get it right if we're looking at it objectively with the tools provided. So what I do every single week is I track this. And I put it in a little minder like this. I manually do it, and it's just part of the exercise that keeps me objective and monitoring what's happening as to, is there alignment between breadth and sentiment? Is monetary bullish or is it bearish? And that's not going to change too often. But is sentiment bullish, bearish, or neutral? Is breadth bullish, bearish, or neutral? Is it turning? Are they all in agreement or in disagreement, and so on? Now, how much of this work you want to do on your own, of course, is your choice. But part of the advantage of the market advisory letter is that I'm doing the work every week, and I'm reporting on that as to market internals, what's happening in the broader markets, and so on. The focus of the ETF letter is just that. Its primary focus is ETFs, but I do comment on different sectors of the market in the advisory letter, whereas in the ETF letter, the recommendations are there as to we're buying this particular ETF and looking to hold on to it intermediate to long term. Where the advisory letter is focused is on swing trades in particular stocks, sometimes ETFs, and of course, we're looking to trade many credit spreads based on various chart patterns as well. So my job here in this seminar is to provide you with the tools to do it on your own, and then you'll decide for yourself how much of this information you want to utilize for yourself day to day and week to week. But as mentioned, if you're utilizing the TC2000 platform as a student, I'm very happy to provide you with the scans that I use to help you do it on your own. So let's move on to the next section and continue to build on what you've been learning here.